Hey, good morning, everybody. Welcome back to the TCC Canada Facebook page. We are very, very excited today to be with Kanwal. He's our small business feature of the week. So Simply Investing is the business, and it's offering a ton of really great information for people. And we've got a really incredible giveaway going on right now as well. So make sure you check that out afterwards. But we are very excited, Campbell, to have you here today. So thank you so much for joining us this morning. I know times are busy for everybody.
You're welcome. Thank you for having me.
Yeah, so what our goal is today is just to get to know you and the business, and really just to put the person behind all of it out there for everyone to get to know. So why don't you tell us a little bit about yourself and how you got started with Simply Investing?
Sure. I'm in Ottawa. I've been here for many, many years, originally from Montreal. I started Simply Investing back in 2007, and that was teaching people how to invest, teaching classes online. Then when we had, teaching in person, and then when we had kids, we moved. I moved all of my classes to online. So I can tell you very quickly a little bit about Simply Investing, and that is teaching people how to earn more, how to reduce their risk, and how to save time when it comes to investing. Over their lifetime, most investors like you and me will unknowingly spend anywhere from $200,000 to $400,000 a year in fees. So that's huge.
Oh my gosh,
So I
that's
teach,
huge.
that is. So in the course, I teach you how to avoid paying those fees, how you can save those fees, and how you can earn more money. Now, investing doesn't have to be complicated. You can probably tell from the name, Simply Investing. So my goal is I teach in plain English. I eliminate all of the complex jargon, and I tell people it's so easy that a 9-year-old could do it. And so both of my kids, when they were 9, started their own stock portfolio, started investing. So they each have their own stock portfolio. My son is 17, daughter's 13, and they've been investing for a number of years now. So
Wow.
it is really that easy. Yeah.
Yeah, what an incredible skill to have in life. They don't teach you that very often. And so the fact that your children have started it so young and the course is set up for that. I mean, I don't know anything about investing, so I think I need to start this course. But it sounds perfect. It seems very user friendly and perfect for anybody.
Yeah, absolutely. I've made it really easy to understand. Anybody can do it. And at the end of the day, I'm teaching you how to build a resilient portfolio of stocks that's going to generate passive income for you. And that passive income is going to grow year after year after year. And that's key, right? At the end of the day, it's that
Hmm.
passive income that's going to cover all of your expenses. And when you can get
Right.
to a point, and I have students who have, they've retired at the age of 35. I have another one who retired at the age of 45. When your income that's coming in from the portfolio is enough to cover your living expenses, then your day job becomes optional, right? So you can continue working if you
Wow.
want to, but you don't have to. So that's really
Yeah.
a nice position to be in. But the younger you start, the better off you're going to be. And that's why I got my kids
Hmm.
started at 9.
They're
But you can,
set.
they're set, but you can start in your 20s and 30s, even 40s. It's never too late to get started.
Hmm.
Yeah.
Absolutely. And do you need any prior knowledge or is there a limit of or minimum that you need to be starting with your course?
Oh, a great question. So no, it's designed for beginners, and for somebody, it's a do-it-yourself approach. So you do have to have
Okay.
that mindset where you're willing to do a little bit of work. I mean, it's about 20, 30 minutes a month, or whenever you're
Okay.
ready to invest. That's when you have to sit down and do some stuff. In the course, I mean, there's a spreadsheet, there's a step-by-step checklist. We go through that. We use real-life examples, so we make it really easy
That's
for
perfect.
anyone to do. Uh, like I said before, a 9-year-old could do it, so the math is not complicated.
Yeah, that's
There's
good.
nothing difficult about that. And in terms of starting, generally $500 to $1,000, right? That's you could start with. My kids were an exception because they're 9, so they started with $100 each. But generally for grown-ups, anywhere from $500 to $1,000 to get started.
Amazing. And how long is the course?
So the course is there's 10 modules, so there's video
Okay.
lessons. The course is all online. I did have plans to teach, but COVID kind of interrupted some of those plans.
Yeah.
So I do hopefully in 2021 when things hopefully get back to normal, I do about 3 or 4 sessions a year where I teach in person. But the
Okay.
course is available online. It takes about 2.5 hours to complete. But you can take your time. You can go back and repeat any
Yeah.
modules if you want. You've got lifetime access to the course, so it's always
Oh,
there.
that's amazing.
Yeah.
Yeah, perfect. So the full thing is online. You teach part of it, or if you sign up for the course, you can do it on your own throughout the whole year.
Yeah, you
It's
can do it all on your own. It's all pre-recorded. You'll hear my
okay.
voice taking the course, and we go through real life examples. Like I said, there's a spreadsheet, there's a checklist. All of the tools are there,
Yeah.
so you can take your time. Right? Some people do it all in one shot in 2.5 hours. Some people spread it out over a couple of days, and you've got access to it anytime. So you can always go back later on and review any of the material that you want to. Yeah. So
Yeah,
I just
that's
want to
amazing.
emphasize it's not a day trading course, so it's not a get rich
Yeah.
quick scheme. It's value investing. So I don't know if you've heard of Warren Buffett or some of your listeners might have heard of
No.
Warren Buffett, one of the most successful investors of all time, who's self-made. So it is a value investing approach. It is slow and steady. Like I said in the beginning, is to save you time, reduce your risk, right? So you work hard for your money and you don't want to risk that. And especially when it comes to investing in stocks, people get really scared, right? They think, oh, it's
Yeah.
gambling and
There's a
what are
lot
we
of
going to do
unknowns.
here? A lot of unknowns, right? And that's why the course is designed for, I don't know if we'll have time during this call, but I'm more than happy to share sort of, I got the 12 rules of simply investing, right? So
Oh,
we go
amazing.
through the 12 rules step by step, and that eliminates a lot of the risk and a lot of the fear.
Mhm.
I've been doing this for over 21 years now, um, and it works, but it takes time, right?
Of
And
course.
like I said, at the end of the day, you're growing a passive stream of income. Passive in the sense that you don't have to work extra hard for it. So you make money while you sleep,
That's
literally.
the dream.
Yeah. So we focus on dividend stocks. So I'll just very quickly explain. A lot of your audience
Yeah.
may or may not know. So what a dividend is for example, if a stock is going to pay you $1 a dividend, and you own 1,000 shares, you'll get $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. So to me, that's amazing. You get paid
Yeah.
for being part owner of a company, and you don't have to work any more hours for that. You don't
Yeah.
have to manage any staff, but you certainly do get paid. Just to illustrate very quickly, just the power of dividends. Over time, dividends, in the beginning, they're not a lot. It might be $1 a share, 30 cents a share. It's not a lot. But a lot of the companies will increase their dividends year after year after year. For example, if we look at Coca-Cola, they've had 56 years of consecutive dividend increases. So they've been paying dividends since 1893.
Oh, wow.
So
Yeah.
think about that for a moment. Now think about how many recessions, how many market crashes we've had in the last 56 years. But companies like Coca-Cola have increased their dividend year after year after year after year. So in the first year you may get $200-300. The next year it's 400, 500. It grows and it grows. And here's an example with Walmart. Everybody knows Walmart.
Yep.
So in 1970, if you had bought 100 shares, or your parents or your grandparents, somebody had bought 100 shares of Walmart and just kept them. We're not talking about buying or selling, just holding on to those shares. Those shares today would generate $415,000 in dividends
Oh,
annually.
wow.
Annually.
That's a house. You could buy a new house every year.
Every year. Think about how many vacations you could have, right? So that's the power of
Absolutely.
dividend increases. That's just 100 shares. At the time, the shares were $16.50. So 100
Totally
times
reasonable.
16, you're paying $1,650. That was your initial investment.
Oh my gosh.
$1,650, and then you just sit on it, and it'd be 400,000 plus dollars in dividends. The 100 shares today would be worth, and I calculated the numbers this morning, would be worth a little over $15 million.
Wow. So it's good to get in when you can.
That's right, and it's just holding it for the long term. Like I said, this is not a day trading course. So we're not constantly buying and selling. I've been doing this for over 21 years. The majority of the stocks that I own, I still own today. So I've had them for 15,
Wow.
20 years. So that's the
Yeah, slow
power of
and steady.
dividends. Yeah, absolutely. Yeah.
Yeah, amazing. So, oh, I had a question. What was I gonna say? Oh no, I was so interested in this Walmart stock. It's gone now.
Yeah, not a problem.
Um,
I was going to share something else with you and the
sure, yeah.
audience. Um, Especially now during COVID, like we've seen over the last 6 months, right? Especially in February, in March, the stock market dropped. And so I received a lot of calls and emails, and people were worried, necessary,
Worry.
Um, and so here, let me put it this way. If there's a chance that you may lose your job, are you going to go out and buy a new car?
Probably not.
Probably not. No.
I shouldn't, at
Are
least.
that's right. You're going to keep the one you have, or are you going to take the bus, or are you going to figure out another way to go about it, right? Before you spend $30,000 on a brand new car. So similar question. If there's a chance that you may lose your job, are you going to go out and book a vacation overseas, an expensive trip?
No.
Of course not, right? So just in these two examples alone, and I cover this in the course in more detail, just with these two examples, we don't invest in car manufacturers or in airlines, right? That makes
Right.
sense, right? And
That makes
I
sense.
explained it to my kids, and they were like nodding their heads. Yes, that makes
Yeah.
sense, because that's where a lot of the risk comes in, is when you buy stocks, and it's the same with mutual funds or index funds or ETFs, because all they're doing is they're turning around, taking your money, pooling it with everyone else, and buying stocks. That's all they're
Yeah.
doing is buying stocks. So when people say I don't invest in stocks, but I have $100,000 in mutual funds, well, that $100,000 is in the stock market and is in
Right.
stocks. So what we do here is we give you more control over what you buy. So, for example, I don't invest and I don't recommend people invest in cars, car manufacturers or in airlines, because those companies are not recession proof, right?
Right.
So
They're not sustainable.
they're not sustainable. What did GM do about a month ago? They cut their dividend to zero, right? So
So
when
that means you lose your stocks, right?
you still own your stocks, but you don't receive any money every year,
Okay.
right? The dividends is the cash. The dividends are cash. It's cash that gets deposited into your account, and you can spend the money if you wish, or you can reinvest it. So in the example of Walmart, if you held on to the 100 shares, you'd get over $400,000 in dividends. That's $400,000 in cash every year deposited into your account. So you can spend the money if you wish, or you could reinvest it. So in the case of
Yeah.
General Motors, about a month ago, they said, well, things are going bad because of COVID. We're not selling enough cars. We are going to eliminate the dividend, right? So when the
Wow.
dividend goes to zero, your passive income from that stock
Stocks.
stops, right? Whereas somebody like Coca-Cola has had 56 years of dividend increases consecutively. Companies like
Mm.
3M was popular in the news recently because they make the masks, the N95
Hmm.
masks. They also make Scotch tape, masking tape, 3M.
Yeah.
3M
They make it
has
all.
had, yeah, I'm just checking the numbers here. 3M has had 61 years of consecutively increasing their dividend. So that
Wow.
is
So
powerful.
yeah, so your course will show you then how to find those recession-proof, sustainable investments for you, right?
Absolutely. Exactly. Yes. Um, do we have 2 minutes? We can go over the 12 rules. I can go through
Absolutely.
it
Of
very
course.
quickly.
Yeah,
Yeah.
we've got as long as we need. Yeah, yeah. Let's
Okay,
do it.
awesome, awesome. So that's exactly it. The 12 rules are designed to reduce your risk, to make sure that you're earning money from your investments, right? And the great thing about dividends is once you've bought it, so if you were to buy a stock today and the dividend was $1 a share, if the stock price dropped tomorrow, you would still get your one dividend of $1 a share. The dividends are paid regardless of the stock prices going up and down, okay,
Mm,
over
okay.
time. So Enbridge has been paying dividends for over 25 years of consecutive dividend increases. Over the last 25 years, the Enbridge stock price has gone up and down, right? It'll go up $2, $3, it'll go down by $4 or $5, and it'll go up again, it'll go down. Especially when we have a market crash or a recession, stock prices go down. But there are certain companies out there that will continue to pay the dividend and increase it every year. And that's what you want,
Mm,
right? You also to cover for inflation. Your cost of living is going to go up every year just because of inflation. So as the dividends keep going up every year, you're able to cover your living expenses. Okay, so let's get to the 12 rules. I'm very excited to share this with you.
Yeah.
So if a company fails even one rule, do not buy the stock. Okay, before we get started.
Big red flag right there.
That's right. Rule number one, do you understand the product or service offered by the company? Right? If you don't, then don't buy the stock. This doesn't mean you have to be an expert in the company, just a general idea, right? So how does McDonald's make money?
They sell food.
That's right. And Walmart, they sell products at retail stores all over the world.
Yeah.
And that's it. What I tell people in the course is you got to be able to explain it to your grandmother or explain it to in plain English what a company is doing. And if you can't answer that, don't buy the stock. Okay, rule number two. Will people still be using the product or service in 20 years? Right? Because you're investing your hard-earned money into a company, you want to make sure the company is going to be around for a very long time. So we avoid companies that are, fads or novelties that they're selling. They're going to be around for a very long time. Rule number three, does the company have a low-cost competitive advantage? So I'm going to explain this very simply. I'm going to use Warren Buffett's example of think of a company as a castle, and around the castle there's a moat, right? So the wider the moat and the deeper the moat, the better the company is going to be able to defend itself against competitors. So I'm going to use Coca-Cola as an example. Everybody knows Coca-Cola. They operate in over 150 countries. They've been around since 1893. You can take that Coca-Cola logo anywhere in the world and show it to someone and they know exactly what you're talking about, right? If you were to start a software company today, think about how much money you would have to spend on marketing and advertising. You'd have to spend billions and billions of dollars, and you still wouldn't get to where Coca-Cola is today, right? If you had to compete against them.
Yeah.
Right. So they've got the low-cost competitive advantage. They do spend a lot of money in marketing, but not as much as somebody who was starting from the ground up.
Okay, yeah, that makes a lot of sense.
Right. So these are brand names. McDonald's is another one. Colgate toothpaste, Pepsi, right? All these big names. Canada is amazing in terms of telecommunications. Rogers, Bell, and Telus. That's it. Those three companies own the telecommunication market. Doesn't matter what kind of cell phone you have.
You've got one of the three.
You've got one of the three, right? So they own, and they're great dividend payers. They've been paying dividends for many, many, many years, and they're not going to go anywhere, right? Okay, number four, because I love this stuff. We can talk about this for 2-3 hours, so I'm going to keep it short. Rule number four, is the company recession proof? And we talked about this before, right? If you may lose your job, you're not going to go buy a new car, right?
Right, no traveling, no cars.
That's right. But you still have to eat. And when you come home at night, you still have to turn the lights on, right? And in the winter, you still have to heat your home. So there's certain things that you need. You always need them. And even during now with COVID-19, the companies that pass rule number four, the companies that are recession proof, are the companies that are still making money, are profitable, and still paying their dividends. And so
now is probably a pretty good time to take a look at what companies are still thriving in this environment, or watching the companies that are pivoting enough that they can continue to thrive.
Yes.
Pretty good time to invest, actually.
Yeah. And so remember, the rules are designed to minimize your risk. And that's what each of these rules are doing. And like I said in the beginning, if a company fails even one of the rules, don't buy the stock.
Right.
Okay, rule number five. We want to make sure that the company has a history of profitability, right? So this is easy to look at. I mean, you can go to Yahoo Finance or any one of these finance websites. I can look up Coca-Cola, I can look up McDonald's or Enbridge or Canadian Tire or any of these big companies. And what we want to see is over the last 10 years, we want to see the earnings graph go like this, right? We want to see the earnings going up. That's good. If you see the earnings going down like this, don't buy the stock.
Yeah, that one seems like a pretty big red flag.
That's right. So it takes 2-3 seconds just to look at the graph and you'll know right away. Okay, rule number 6. Does the company have consistent dividend growth? And again, we want to see the dividends going up every year, right? If they're going down, don't buy the stock, right?
And is that something that you teach, where to look for those dividends?
Yes. Yes.
Okay.
Yeah. So again, Yahoo Finance or any of the Google Finance, any of the websites where you can get a stock price, You can go up there and you can look at the graph and you can see what the dividends have been for the last 10 years. So yeah, and rule number 6 is important because that's what's putting cash into your pocket, right? That's what's going to pay your living expenses. So you want to see the dividends going up. And nobody can predict the future. I don't know what the stock market's going to do next week or next year. Nobody knows that. But when you look at the history and you look at companies like 3M, who's had 61 years of consecutive dividend increases, Coca-Cola has had 56 years. When you look at companies like that, you have a high degree of confidence that they'll continue to pay the dividend. Right?
Gotcha.
Does that make sense?
So yeah, it does. Checking off the past and making sure that the future will probably fall in suit.
That's right. Yeah, and again, they're recession-proof. They're going to be producing products and services we're going to be using for the next 20 years. They're going to be around for a while. Okay, rule number 7. This is a great example here. So I'm going to ask you this question. So if a company earned $2 a share, earnings per share, that's profit, right? $2 per share, and they paid out a dividend of $1 per share, that's pretty good, right? The company is earning $2. They're paying $1 back to the shareholders. The rest of the money they're keeping and reinvesting it back into the business to grow the business. So here's the question. Let's say another company is earning $2 a share, but they're paying a dividend of $3 to the shareholders. What's wrong with that?
Yeah, they're not making any money. Are they losing money at that point?
So they are making $2 per share, but they're turning around and paying $3 to the shareholders. So that doesn't make any sense. That means they're borrowing money from someone else to pay the shareholders.
Yeah.
So rule number 7 says don't invest in any company where the payout ratio is over 100%, right? So that's where the risk is going to be, right? So that's very easy to check. And once you look at that and you say, okay, well, no, the company fails rule number 7, I'm not going to invest in it.
Mm-hmm. Well, that makes sense because I cannot imagine a company being sustainable that is continuously borrowing from shareholders.
That's right.
Isn't the point of investing or borrowing to pay the shareholders? The point of investing is that you're getting financial help, right, from people to keep the company going. But if you're having to pay extra on top of that, then you're not actually making any money.
That's right. Yeah. So the payout ratio should never go. I look at over 75%. Should never go over 75%.
Oh, okay, that's a good rule of thumb to go off of.
That's right. Yeah. So the first example I gave you is the company's earning $2 a share, and they're paying to the shareholders a dividend of $1. That's good. That's a 50% payout ratio. So that's good. So that's what we want to look at. Okay. Rule number 8. Does the company have low debt? So I'll keep this really simple. Let's say all things considered equal, we're looking at 2 companies, Company A and Company B. Company A has a debt of 10%. Company B has a debt of 400%. Which company do you not invest in?
Probably not the 400%. That seems like a little excessive.
Absolutely. And it sounds excessive, but today, right now, you could go onto Yahoo Finance or Google Finance, and you will find companies that have debt of 400%, 500, 600%. And they're there, right? You're investing your hard-earned money. Why would you invest it in a company that is carrying so much debt? And the problem when the stock market crashes, and we know it'll happen again, markets go up and down, right? Yeah. It's going to happen again. Companies that carry so much debt are going to have a very hard time surviving a market downturn, right? So you don't want to invest in that. So that's what rule number 8 is looking at. Low debt. So 70% or less. That's what we look at.
Okay.
Rule number 9, credit rating. So Standard & Poor's has credit ratings. And again, you can look these up very easily. So we look at a credit rating, and the ratings go from AAA down to B, C, D. It's kind of like getting a grade in school. Then they go to F, right? So we want to avoid the companies that have a credit rating of F or a C or a D. Yep. So we look at triple B or greater, right? So that's really easy to check. Yeah. Number 10, we look at, does the company actively buy back its shares, right? So when companies buy back their own shares, the shares that are outstanding in the market, there's less of them. And so the value of those shares goes up over time, right? So over time, you want the shares to be worth more. Okay, number 11. We're getting close. We're at number 11 here. We want to make sure that the stock is undervalued or priced low. So everybody says buy low and sell high.
Yeah.
But how do you actually figure that out? How do you know when a stock is priced low, right? And the reason for buying a stock when it's low, so let's say a stock goes up and down, right? So low is $10, high is 50. There's no point in
Yeah.
buying the stock at $50 because it's already historically that's as high as it's going to go, right? Or even buying a stock at $49 because it's very high. You want to buy it
Right.
closer to the $10 range, right? Because you're going to
Mhm.
maximize your profits over time. So that's what we look at, rule number 11. And I teach that in the course because I'd love to go, it's going to take too long. It takes about 20, 30 minutes to go over the whole exercise. But I do show people in the course exactly how to do that. It takes about 20 minutes. We cover all of the theory behind it. And
Mhm.
then you know exactly when a stock is undervalued. So we want to make
Oh,
sure we buy
perfect.
stocks when they're undervalued, right?
It's kind
Okay,
of like buying a house.
absolutely, right? Or this is you made a great comment because now
I don't know why
I'm
I'm opening
very
the floodgates.
this is right. I'm so passionate about this, right?
You
This
can tell. Yeah, I love it.
the stock market is the only place in the world where people buy when prices are going up because and
Yeah.
then they panic when prices are going down and they sell. And that's exactly the wrong time to sell is when prices are going down, right? Think about anything else in life when you're grocery shopping, shopping for clothes, shopping for electronics and stuff. You want to buy this stuff when it's on sale. When it goes on sale, you buy more because it's priced
Yeah,
low.
and people wait for it to go on sale.
Exactly. And you should do the exact same thing with stocks. Wait for them to go on sale.
Okay.
Absolutely. And that's what rule number 11 says. So if a company passes the first 10 rules, but it fails rule 11, then don't buy it. Just be patient. Wait for it to
Right.
be priced low. So I
And
love
it
that.
will
I love
come
what you
down,
said.
right?
Exactly. It's all in cycles. The stock market and stocks go up and down all the time,
Mm,
right?
okay.
Last one, rule number 12. Rule number 12 has nothing to do with looking at numbers, nothing to do with looking at stocks and financial data, none of that. It has everything to do with you as the individual. And this is the hardest one. Rule number 12 is the hardest one. You
Oh
need to
gosh.
you need to keep your emotions out of investing. And I
That one makes
know
sense.
when it comes to money, it's very difficult. I get emotional about money. People get emotional. People fall in love with a stock, you know,
Mm.
Tesla, Facebook, Twitter, a whole bunch of these stocks that are out there, and you just fall in love with it, and you just kind of and you make mistakes, right? So rule number 12 is you need to have the discipline and the patience. So the discipline is to stick to the 12 rules. So don't break the rules, no matter how
Yeah.
good it seems. No matter if somebody says, "Hey, you should take a look at the stock. It's going to go up 200%. You should buy it." Follow the 12 rules. Have the discipline to go through the 12 rules, and then you got to have the patience to ride out market downturns, right?
You gotta let
So
it grow and do its thing first.
absolutely. And that's why we say when it comes to investing, same thing with mutual funds and index funds and ETFs. When you're investing money in the stock market, it has to be for 5 years, 10 years or more. So it can't
Okay.
if you're saving to buy a house next year or you want to buy a car or go on vacation, do not put that money in stocks. Not even the 12 rules, right? Do not put that in index funds or mutual funds because in the short term, markets go up and down.
Hmm.
So let's say you've put, you have $20,000 and you're saving that to buy a house next year. If you put that $20,000 into stocks or in mutual funds, and next year when you're ready to buy the house, now it's only worth $15,000. Now what are you going to do, right? You're going to be
Hmm.
stuck, and you don't want to be forced to sell when prices are low.
No,
So
right.
you got to have the patience to ride this out for the long term. And
Yeah,
so
so this is a long-term plan. This isn't something that you're looking at pinpointing. In 3 years, we're going to go on a vacation. So let's put all our money into stocks and it'll grow to this huge thing.
mhm. 5 years
Gotcha.
or more. 5 years or more. That's
Okay.
that's the money you're not going to look at for the. You don't need the money for the next 5 years or more. So it's great for
Hmm.
RRSPs or TFSAs. You can
Right.
open up a trading account, an RRSP trading account or a TFSA trading account, which is
Mhm.
fantastic because all the dividends come in tax free,
Yeah,
which is
that's
amazing.
perfect.
All your
Yeah.
capital gains are tax free, which is amazing. So you can certainly do that, and that's what I
Okay.
recommend. Yeah. Okay, so those are
Wow.
the 12 rules. I can talk about this forever, but I'm going to
No, that
stop
was
it here.
perfect. I think that was so much information and just enough for everybody, I'm sure, watching right now to go, I need to get this course. I'm looking at it going, I need to get this course. My goodness. So why don't you tell us a little bit about the services that you offer with Simply Investing, and if there's been any changes to the business since COVID started with the shutdowns and stuff.
Okay. So just the changes have been, I like we spoke before we started the call. I had 5 speaking gigs this year, which was with the International Money Show, with FinCon, the Financial Independence Summit as well. So all of those got canceled, right? Which is unfortunate, but I think it was the right thing to do. You don't want to be traveling with all of this stuff going on right now with COVID-19. So all of
Yeah.
that got canceled. I had 2 live classes that I was preparing for in Ottawa and in Toronto this year as well, so I had to cancel those. So hopefully 2021 will be a better year where we can travel and do these
Fingers
live
crossed,
things.
yeah.
Hopefully, so I'm hoping that'll continue. So we'll get the live stuff going. In terms of products and services, we've already talked about the Simply Investing course. So it's an online course. Everything you need is there. I'm not selling mutual funds. I'm not selling insurance. I'm not selling anything else. It's education. I really want people to learn this stuff, and really they should be teaching this stuff in schools. They
They
should be
should be.
teaching this in high school to everybody. So the course is available. I do have the Simply Investing report, and that's what we're giving away today, is a 1-year subscription to the report. So what the
Yeah.
report does, and I'll explain very quickly, it's really designed for folks who don't have time to take the course, right? The course is a
Okay.
do-it-yourself approach, and I understand. I've got 2 kids, and I understand if the parents are both working and you've got kids in school, it's very, very hard. You don't have a lot of free time, right? And you don't have time to take the course. So what I do in the report is I track 235 stocks in the US and in Canada every month, and I apply the 12 rules of Simply Investing to all of them.
Oh, perfect.
So every month, at the first of the month, you'll get a PDF. It's a report, and it shows you exactly here's the stocks that are undervalued, they're priced low, and they pass
Mhm.
all the 12 rules of Simply Investing. And here
So
you
you're
go.
just giving it to them on a silver platter.
So
Here's where you need to put your money.
just to make it a lot easier. So the report is
Yeah.
available. So yeah, so I have that.
That's an incredible giveaway. So make sure if you have not entered this giveaway that you go to our Facebook page, scroll down, you'll find it with Simply Investing, and it's open till tomorrow night. So you've got about a day and a half left to enter. It's going to be awesome. We do have a couple questions just before we wrap up here. It says, hi, Kanwal. I've been following your 12 rules. It's been really helpful. Quick question. While some of the companies have stopped their dividends during the pandemic, when do you expect to add those back?
Okay, great question. So there's been not a lot. There's been a few companies from the ones that we track, especially in the report, the 235. The majority of those companies have not cut their dividend. So that's good news, right? I know the
Mhm.
media is full of dividend cuts and they like to emphasize General Motors, Boeing, and Disney, which all 3 of them cut their
Yeah.
dividend, right? But think about that for a second. General Motors is not a recession-proof company. Boeing builds airliners, not a recession-proof company. Disney was a bit of a surprise, but I think it's only temporary with Disney. They're going to ride out this COVID-19, and hopefully things will recover. So the majority of companies have not cut their dividend. The ones that have, I still track them in the report, Simply Investing report. So you'll still see them in the report because I do believe that they will reinstate the dividend in the next 12 to 24 months. So it will come
Okay.
back. Yeah. So
Amazing.
I'll keep tracking them.
Okay, that's good to know. And then the next comment says we can keep investing over time in dividends paying stocks. However, how do we know that we are at the peak of the stock and at what point do we decide to actually sell it?
Yeah, that's a
It's
good
a really good
question.
question.
Yeah. So we talked about in the course, I teach you how to figure out when a stock is undervalued. I wish I could do that now, but like I said, it's 20, 30 minutes, so it's going to take too long. But it is really simple. So I teach you how to figure out when a stock is priced low. I also teach you how to figure out when a stock is overvalued, when it's priced high, right? So once you have
Okay.
that knowledge, and in the report every month I publish out of the 235 stocks, I tell you which ones are undervalued and which ones are overvalued. So you get two lists, two tables. So you know exactly
Yeah.
what to look at when you want to invest and what to avoid. So you've got the overvalue stocks here, the ones you should avoid for now. So
Yeah,
we cover
perfect.
both overvalue and undervalue in the course and in the report. And to answer the question, how do you know when to sell? I do have, again, I would love to talk about this, guys, because it's a,
We'll have
there's
to
a,
bring you
there,
back on again
that's
since you know
right,
it very
yeah.
well.
So there is a module, there's a video module I put together in the course, and it's a checklist. There's 8 steps. We go through the checklist, and it'll tell you exactly, should you sell the stock or should you just hold on to it? And so you got to go through
Yeah.
those 8 steps, right?
Okay.
So we make it very easy to figure that out because that is important. It's important to know when to sell as it is important to
Yeah.
know when to buy. Yeah.
Right. Amazing. Well, thank you so much for taking the time today. This was so helpful in being able to get to know a little bit more about the business. And you're clearly, you're passionate and you know what you're doing. It's perfect. It's exactly what we like to see in small businesses. I mean, you can't be successful if you don't have passion behind what you're doing. So this is amazing.
Yeah. Thank you for having me. I really appreciate it. It was a lot of fun.
Absolutely. So yes, it was so good to get to chat to you. When you get a second, what I'll ask you to do is just put some of your contact information into the comment section. That way people can get in touch if you can, and then that way they can go check you out a little bit more too.
Okay. Awesome. Thank you.
Perfect. Well, it's nice chatting with you. Thank you, everybody who joined us today, and don't forget to enter that giveaway. Have a great
Okay.
day.
Take care. Bye.
Bye.